Good afternoon. Welcome to this live cast of the Conference of the Finance and the Common Good program. Finance and the Common Good is a joint initiative of the Sustainable Finance Lab and Socires that explores the feasibility of an alternate arrangement of the financial sector. How can finance set goals together with state and society to make sure that finance is in service of the common good? This session this afternoon is organized in collaboration with the Sustainable Pension Investments Lab, the SPIL, and the Erasmus Platform for Sustainable Value Creation. My name is Masha Zandbergen. I'm Head of Sustainability Integration at Robeco, and I will be chairing this session. Still, due to the coronavirus, of course, we cannot be live here, but we have good connection with everyone via Zoom, I hope. The topic of this session is long-term sustainable value creation. We live in a world where we face some very big issues that are long-term: climate change, loss of biodiversity, increasing inequality, to name but a few. And if we do not solve these issues, the economic and social impact will be enormous. The COVID crisis, I think, has shown us that even low probability events can have enormous consequences. But we also live in a world where CEO tenures continue to decline to a median of about 5 years now in the US. So how can investors, and specifically pension funds, make sure that not only a current generation, but also future generations continue to get pensions in a livable world? In today's session, first, we will hear from Mats Andersen, former CEO of AP4 and board member of the PRI, who is joining us from via Zoom. And we will hear about how investors in Sweden make sure that their long-term interests are safeguarded by companies they invest in. And then we will have Dirk Schoenmaker, Professor of Banking and Finance at the RSM, who will present a new theoretical framework to understand where companies are in the transition to a sustainable economy, and also how to use this information in corporate and investment decision-making. And Dirk is here in the studio with us. Welcome, Dirk. After the two presentations, we will ask if and how the Dutch pension fund sector could incorporate the ideas presented. And we will be joined on Zoom by Joanna Kellerman, the chairman of the Pension Fund for the Health Workers in the Netherlands, and by André Snellen, chairman of the Pension Fund for the Retailers. Welcome, you both.
Thank you.
I'm hoping for a lively discussion today, and I would also like to encourage you at home to participate. You can ask questions via the Zoom session. Via the chat, you can discuss among each other. And via the Q&A button, you can ask questions to the participants in this session. And if you want to ask a question for a specific participant, then please also mention that in your question. So, let's get started. The first presentation will be from Mats Andersen. Mats held several management positions in the financial sector, most recently as CEO of AP4. And today he serves as vice chairman of the Global Challenges Foundation and is also a non-executive member of the board of the PRI and several Swedish companies. In 2016, he was awarded the CIO Lifetime Award for his leadership at AP4 and his contribution to international initiatives to further sustainable investment and also to mitigate climate change risks. So I think he's an excellent speaker to talk about his experience as a long-term investor in companies. Mats, the floor is yours.
Thank you. And thank you for inviting me, giving me this opportunity to speak on sustainability in general and more specifically on the G governance in sustainability. So first of all, can I have a short words on AP4 and the investment beliefs we had at AP4? Number one, we were a long-term investor. By law, we should invest on a 30 to 40-year horizon. And if you have that long-term approach, sustainability must be on the agenda. So that was one of the key focus areas for us. Thirdly, we believe in individuals rather than models. And last but not least, when we invested or found new ways to invest, we also asked, is this good for the pensioner? And that sort of gave us the best solution possible, cost-efficient one to be. So now on to sustainability. If we can move on to the next slide. In my view, there is no conflict between sustainability and good returns. Sustainability, in my view, is a way to mitigate risks. We know that there are mispriced risks out there. We know that from coal, we know that from fossil, etc. So again, it's got nothing to do with charity, it's got nothing to do with look good. And I would also argue that actually our fiduciary duty as a long-term investor to address this. To my big surprise, when you look at the three letters of sustainability, E, S, and G, we have a lot of focus on E and S and very little on G. And those of you that have been around for some years know that 15 years ago we had GES, but my experience is nobody really understood the G, so they moved it from being the first letter to the last one. But I think that it all starts with governance. Governance is actually the toolbox you can use when you want to address the E and the S. And I never understood how different governance models are in the different corners of the globe. So if you move on to the next slide, let me give you 3 examples. And the next slide as well. There is a Swedish model that I've been brought up with, where you have actually the big owners come together in a nomination committee, and they interview the chairman, they interview the CEO, and to get an idea what is ahead of the companies. And then you can actually make sure that you get the right people on the board, given where you want the company to go. And also it's important to say the only ones that can actually give a long-term mandate are the owners. And by engaging nomination committees, I think that's an excellent way to actually start. And at the AGM, you have a vote for real, who's going to be on the board. And on the board, you only have non-executive directors. You have separated the rule of being the chair and the CEO. So it's a very transparent and it's very clear where the responsibility lies in different phases. If you look at the US model, I think or the American model, I think it's a very poor one. We know that AGMs in American companies are bizarre. I mean, the board actually elect themselves, evaluate themselves, and remunerate themselves. And I think that is probably one of the reasons why it looks as bad as it does in many American companies. It's also common that you have the chair and the CEO in the same person. That is, for example, forbidden in Sweden. If you move to the German model, we know that you have boards of 25 to 30 people, half of them elected by the unions and half by shareholders. At AGMs, you're allowed to put one question only. So it's a totally different model again. I learned that in Japan 15 years ago, all AGMs in all Japanese listed companies were at the same time, the same day, the same time. So you can imagine the possibilities to actually have an influence or being active owners. It's absolutely nothing. And I was speaking at the conference in Tokyo some 10 years ago when I spoke about the Swedish or Nordic model on governance. And afterwards, in a coffee break, a professor from a South Korean university came up to me and said that interesting to learn about the way you deal with governance in Sweden. Do you know the owner structure of Samsung? And I said, no, I don't. And then he showed me this picture. Next slide, please. And I think that it's obvious to me that in this case, you probably don't know what exactly well. You can't be sure that $100 of profit actually end up with the owners. I think it's an opaque system. So I think, again, that governance matters. If you want to give the long-term mandate, if you want to have checks and balances in place. And I think, next slide, that's probably one of the reasons why Sweden has outperformed MSCI on a 5, 10, 15, 20, 25-year basis. So again, sustainability is not about look good. It's all about mitigating risk. In this case, making sure that we have the right management and the right board. And by doing that, you actually get better returns on that. So I have always been surprised that outside Sweden, very few long-term investors like pension funds, they don't seem to be interested in actually have a more active role in making sure you get the right people on the board. So my conclusion is that, or the idea is to ask and actually say that if you're a long-term investor as a pension fund, step up to the plate, become an active owner, make sure that you actually get the right people on board. And if we do that, I'm sure that we'll get better returns and a better sustainability. Thank you.
Thank you, Mats, for that interesting view. Can I ask you, you have quite concentrated portfolio in Sweden, but of course a lot of us are global investors. How do you think we can manage being so involved with companies as you have been with your fund?
I think it starts with your own sort of home market. I think that and you can play different roles, but I mean in Sweden, AP4, we were on some 30 to 40 different nomination committees, making sure again that we actually had the right people on board. As an active owner, especially in your home market again, we were able to reshuffle actually a couple of big companies where we were not happy with the management, not happy with the board. So it's possible to do. And then at AP4, we actually had the companies where we own more than 5%. We invited the CEO and the chair once a year just to make sure that they understood that we have the long-term mandate and we want them to have the long-term view on things. We encourage them to actually make sure that when they report on a quarterly basis, start off with actually the long term before you address the short term. So that's the way to deal with it again in Sweden for a Swedish pension fund. If we moved outside Sweden, you have different strategies. Number one was we always want to engage, but sometimes it's impossible to engage. And tobacco is one of those. I mean, tobacco, in my view, is morally wrong to have for a pension fund. Secondly, I think it's a mispriced risk again. So from financial point of view, I think we should leave tobacco. So again, engagement doesn't work. Then if we want to really have a view on a company outside those sort of examples, I think the best way would be to cooperate with other pension funds. I had a dream once at AP4 to be able to build a network in different countries with pension funds and long-term investors that shared our view on sustainability and being a long-term investor. And I would be happy to give them the voting rights of the holdings we had, and the other way around. If I could get their votings for Sweden, our voice could be even stronger. So I think there are different ways, but I mean, you have to acknowledge and you have to say yes to actually being an active owner and taking part in nominating the right people on the board. That is because, I mean, how many companies have you come across with an excellent chair and a poorly run company? I think there are examples, but I think there are very few. And that sort of gives me the message that, again, if you do this, you will actually be rewarded.
Thank you.
Thank you.
Thanks, Mats, for sharing your dream with us. We will come back to it later to see how we can apply that in the Dutch pension fund sector. But I would like to go to the next speaker, Dirk Schoenmaker. Dirk, as I already mentioned, is Professor Banking and Finance at the Rotterdam School of Management at the Erasmus University. And he's also a member of the Sustainable Finance Lab. And his research and teaching focuses on areas of sustainable finance, central banking, financial stability, financial system architecture, and European financial integration. And he is a co-author of one of the first textbooks on sustainable finance, the Principles of Sustainable Finance. And Dirk is also the initiator of the Sustainable Value Creation Platform at the Erasmus University that brings together academics, but also practitioners like me. And through this cooperation, I have come to know Dirk as someone who is a strong advocate for sustainability integration and always thinking about the theoretical frameworks that we can develop to make sure that everyone understands what we're talking about here. So, Dirk, the floor is yours.
Thank you, Masha, for a nice introduction. And I'm happy to be here, and hello to everybody at home. Long-term sustainable value creation. This is joint work with Lars Kutsnak and Willem Schramade. And what I would like to do is to work out the dream of Mats. So Mats is saying if every big investor would take a long-term view in its home market, then we can cover all big companies. But then the question is, how can we come to that long-term view? How can we, what are the building blocks of this long-term strategy? That's the motivation of this paper. And that's values-driven. So we really believe that pension funds, large investors, have a moral responsibility to take care of their investments, that they have a positive impact rather than a negative impact. And the aim is to identify long-term trends. Masha, you mentioned them in your introduction. They are on the sustainability front, but also like digital, demographics. You take these trends, and how can we incorporate these trends in the long-term view of a company? That's the aim of the model. And rest assured, I'm not going to give you the model, just the building blocks. And we have an investment belief, and that is the same as Mats, that investing in sustainability is future-proofing your business model. So there's a moral dimension to it, but on top of it, there is a business case, because if you invest in the future, it is value-enhancing. So what are the key trends? The first is the landscape. The changing risk and opportunity landscape for companies. And then we have like the energy transition. Today, COVID comes with demographics is quite powerful, social inequality. So there are quite a few risks, but also opportunities. Second, the speed of change. We're always saying that, but it's also true, is accelerating. So you really have to be quick to pick them up in order to cater for these trends, otherwise you are behind the curve. And the third one is we as citizens, we expect something different from companies. So we expect them to behave properly. We call it license to operate. Like if you're a pharmaceutical company, we don't expect you to increase your prices for drugs now during the crisis. We just expect you to increase your production to cater for the health. And long-term value creation is now incorporated in the corporate governance codes of leading countries, Netherlands, UK, probably also in Sweden. So we expect from companies to behave in a proper societal way. Now the model, and I promise you no equations there in the paper, but here the building blocks. So first of all, we make a transition curve for each sector, and I will show you this transition curve. So you have the bottom line is the time axis, and the vertical line are the trends. And if you cater for the trends, whether it is sustainability or digital, then you can sell services and goods in line with these trends. If you miss these trends, you lose your market share. So the first one is, what is the transition curve for each sector? The second line is, and that's why this idea of Mats, that as pension fund you talk to your company, to the CEO, to the chairman, to talk about the long-term strategy, because you want to know whether the company has the capabilities to serve these long-term trends. So are they aware and are they preparing for it, or are they behind the curve? That's what you want to know. And as an investor, you can only know it by talking to the company. Know reports help for that. It is the real life contact between investors and companies. And the third one is in the model is if we do this, if we build up these capabilities, then the company is able to grasp the long-term value potential. So if they are preparing for the future, they can really get it back in the value of the company. And let me give you an example. So I did show you the transition curve. And now I'm moving to the electric car industry. And we all know the rise of electric cars. In some countries, you get a premium on buying an electric car during the COVID crisis. So the top line is the transition curve. And you see it straight away. Tesla is quite close, so they have built the capabilities in the past. They can serve this market. And you know, they're even shipping them, for example, to the Netherlands, not to car dealers, but just to the port in Amsterdam, and you can collect your car from the port, because it is so massive. Volkswagen, we all know from the Dieselgate, was quite late, so they put the chips on fossil fuel cars. And now they are far behind. So they didn't build the capabilities for electric cars. So they cannot cater this market. If you order an electric Volkswagen, you have a waiting time of a year or half of a year. So they are far behind in their production. And that's what you see in this transition graph. So they are way below. They cannot serve the potential market. And what's happening to the value? So Tesla operates this electric car market, and well, this is even an underestimation. Their stock price, I don't know whether it's too high or not, but keeps on rising because they are really hitting the new market. Volkswagen is behind, not only because of Dieselgate, but also because they are behind in the new world. And maybe they can do catch-up investment and catch up, maybe not. So that's really what you want to see at your company, that they prepare for the future, and Tesla did, and Volkswagen is behind. So this talking from the investor to the company should be about, do you have the long-term capabilities to prepare for the future? And of course, sustainability is a key one. Wrapping up, so we start with investors doing a fundamental analysis of companies. So really looking at companies, not at portfolios. Then on the base of their analysis, they select the most prepared companies or the companies where they think they can help out with the catch-up. And then they do engagement, like the annual meeting in autumn in Sweden, where the asset owner talks to the CEO and the chairman, where you talk to the company and discuss the long-term strategy. And then you seek the right people to execute it. And that feeds into your analysis of the company. So in that sense, you get a virtuous cycle of sustainable investing. And then the big reason why we think we cannot do it. So at my university and at other universities, you learn we have to diversify our portfolio and we have to invest in the market index. Empirically, after 50 to 100 stocks in different sectors, you already have captured most diversification gains. Then you don't need more stocks in your portfolio for proper diversification. So you can have a small portfolio with larger stakes, because then you can really do engagement with the company. And everybody tells me that the supervisor is not allowing that. I've discussed it several times with the supervisor, and there is no rule that everybody should invest in the market index. So it is allowed, but do you dare to do it? That's the big question. So we move from the financial to the broad dimension, financial, social, and environmental. And then we always learn finance is about anticipating events. So if we anticipate these long-term trends, we invest in them today, we can speed up the transition because we help out the sustainable companies. And long-term patient capital from the pension fund is really well placed to really cater for these sustainable companies. Thank you.
Thank you, Dirk. We have a question from the audience, from Connie, which I think we also need to address because we talk about long-term sustainable value creation. And the question is, what do we mean? You also talk about other trends like demographics, digitalization. Yeah. So can you define for us what we mean by long-term, or what do you mean by long-term sustainable value creation? I mean, I think you already alluded, of course, in your presentation, but can you just for the audience,
The trick is to think beyond today. So really have a 5, 10, 15-year view. And it is industry specific, so each industry is different. And a really good example is, for example, the oil industry. We all know today they can still sell the products, but in 20 years' time, not anymore. And now the new chair, the new CEO of BP, said, okay, we are preparing that in 2030 we will sell less oil. And he has now made a strategy with that in mind, that if the world changes, not today, but in the future, that his company is prepared in a low carbon world with less oil, that his company can survive. So he's preparing for the future.
Yeah, so future-proofing your business model. Yeah. That's what you're saying.
And that's where the value comes from paying attention to the social and environmental factors in the future.
Okay, thank you. Jaap van Dam from PGM also asked a question for Mats. What percentage you own of companies in Sweden? And I think, Mats, you already mentioned in your presentation, sometimes you even own like 5% of a company. Can you maybe answer that question? And
yeah, we had briefly about one third of our portfolio was in domestic equities, and that's a huge overweight. Of course, I think Sweden is probably not more than 1% of MSCI. But we defended that by saying that we can actually have a stronger view on as an owner in the domestic scene. And then we were allowed to own up to 10% of capital or votes in a listed company.
Yeah, thank you. I think that gives a good idea of the diversification versus the being an owner with a big percentage in the company. Let's get some free reactions from the Dutch pension fund board members that we have. André Snellen is here in the studio. He's chairman of the pension fund for the retailers in the Netherlands, Pensioenfonds Detailhandel. And among others, he's also a board member of the Dutch Pension Fund Federation and a trained economic psychologist, which I just really like that is your background. Welcome.
Thank you.
And we have Joanne Kellerman. She's joining us on Zoom, and she's a former board member of the Dutch National Bank and tasked with the supervision of, among others, the Dutch pension funds. And currently, she's the chairman of the pension fund for the healthcare workers in the Netherlands, PFZW. Welcome, Joanne. Let me start with André. André, can we make the dream of Mats come true? The dream of making sure that in each country, everyone takes care of, let's say, the long-term future-proofing of the businesses of the companies in that country. He was even willing to give you his voting rights, for example.
Thank you.
Do you have a reaction? How can we apply it to the Netherlands? Is it possible?
Making dreams come true is not in the bylaws of the pension fund. Our aim is to provide pensions. That's the first thing we do. Of course, we can add to the dream, and I think we should add to the dream. Mats referred to active ownership, and I think through active ownership, and that's easy to do, engagement, we can add to the dream and make it come true a little bit, perhaps. But active ownership also involves active investment. And Mats and Dirk also refer to investment beliefs. The investment beliefs of the pension fund for the retail sector is that we cannot beat a well organized market. So we are passive investors. We just follow the market, and that's what we do. I do believe that markets can be beaten, but I don't believe that I can do it as a pension fund. And then there are things like you can engage with companies, but if you can't get out a company because you don't have segregated accounts as a pension fund, but you follow the benchmark through a fund that you invest in, which many pension funds do, then you can engage, but you can't get out of the company. So your instrument, the instruments you can use are, not there.
Yeah.
So making the dream come true, if we can help a little bit, yes. And Mats referred to engagement, cooperation through engagement. We, as a pension fund for retail sector, are collaborating with the pension fund for the catering sector in the Dutch engagement network, and it's copied from a Scandinavian model where different pension funds try to improve their influence on companies to have a better risk return. You refer to values, risk return values. That's two different things. I think we'll come to that later. So yes, we can add to it, but don't expect too much from us.
All right. Well, thank you for bringing up some hurdles, but also giving us some kind of light in the darkness when it comes to collaboration. Joanne, what is your opinion about making Mats' dream come true? Is it possible in a Dutch pension fund context, you think?
Well, I think the answer is a bit like Andre already said. It's a bit of a yes and a bit of a no. The pension fund that I chair, PFZBU, is also mainly a passive investor. Although 5 years ago we've started a portfolio that we call Investing in Solutions, and that we plan to develop into a much bigger portion of our investments, where we seek and select investments that are solutions to the global problem we're facing, which we will define in terms of solutions to the Sustainable Development Goals. And that, to my mind, is an area where we don't necessarily have to remain a fully passive investor, but where we can steer and where we can reward, as it were, good behavior of companies. And that is certainly our intention. With Andre, I agree that in terms of engagement, it depends a little bit on how you're organized. But if you're in a fund, or if you're tied to a certain benchmark, there's only so much you can do. And this is one of the other areas where we, as a board of the fund, are currently working on how can we revise that strategy. So that at a certain point we can say to companies, okay, 3 strikes and you're out. To a point, actually, we also have that obligation under the OECD guidelines to start screening our portfolio to make sure that the companies we invest in comply with those guidelines. So I would say on a more macro level, there's a lot more we can do actually than we do today. On the other hand, the dream of Mats, where every pension fund invests in their local, let's say, local heroes and engages and is very engaged. I actually have some questions back for Mats there. One is, I know that we are in an era where we are sort of taking a step back from globalization and focusing more on local. But to what extent is it appropriate or even realistic to stay within national boundaries? Shouldn't we at least look at the EU, for instance? And secondly, I really like what Mats has said about governance. I think it's a very important thought that I like to keep. At the same time, governance is one thing, but isn't actual behavior the proof of pudding in the eating? And to what extent, how far do you go as an active investor? Selecting boards is already pretty far, but once they're selected, how do you watch closely what they do and whether they put their money where their mouth is, really? Thank you.
Thanks, Johan. Mats?
Yes, please.
That's a good question indeed, because that's what engagement, I think, is about, and we need to make sure that that we really get companies to change. So, how do you?
Number one, I think that we owned in Sweden about 2 or 3% of the local market at AP4, but we had a voice 10 times that because we knew everyone. And if I wanted to get in touch with the 10 largest owners in Volvo, Swedish owners, it would take me less than 2 hours, and I knew them all. So if you have those possibilities, it's much easier to actually have an impact, and that was shown several times during my 10 years at AP4. Then you mentioned you pick the board. Yes, you do, and you actually give them the mandate. And that's why it's important that you have a nomination committee that yearly evaluates what they're doing, and that is actually what's happening in every listed company in Sweden. And that is reported back to the nomination committee. You interview actually each and every member of the board, and you get the view from the chair on how the board is working, if there are competencies missing, and you get, again, an idea from the CEO on where the company is heading. So I think, again, governance, it starts with governance. Unless you have the right governance and the right possibilities to actually have an impact, you will never get to the E and the S. So it starts with governance. And if you have the right governance, you can actually push those things. I mean, someone told me, that was it 5 years ago when Shell had, at the AGM at Shell, there was a quest for actually reporting better on Shell's operations in regard to COP21 and the target of not getting over +2 degrees. And 98% of those at the AGM supported that idea, and it was voted through. At the end of the AGM, one of the board members raised his hand and said, well, just so you know, I mean, we're aiming for 3 degrees. And in my view, if he should never be representing those 98% that were actually taking this extremely serious. And again, you need to use your vote in actually making sure that you got the right people on the board. And I think that's one example and you can go on with the oil sector. I mean, why on earth? Yeah, sorry.
Sorry, Mats. Thank you. That's a very good example, I think, and that brings me to the second point that I. Oh, Dirk, you also wanted to have.
I wanted to pick up on the idea of Joanna that can we have an EU strategy? There is academic evidence that if you do coordinated engagement, that means there is one lead and others cooperate, that it has quite a big of impact on the company, both on improving the sustainability profile, but also improving financial performance. And then Mats' strategy could work. So we in the Netherlands take the lead with the Dutch companies, the French, with the French companies and so on. And Elroy Dimson has done quite a bit of research on it with data from the Principles of Responsible Investment. And he finds significant effects, that it really works. And in that way, the voice of pension funds, and we know that the stakes which are held by institutional investors is increasing, in the end has power. So I think that both you and Andre are underestimating a little bit your power, that if you do it jointly and wisely, you can help companies to move faster. And the evidence is that it is working.
Okay. Thank you, Dirk. So I guess when I listen to all the speakers, it's passive investing versus very concentrated active investing, and engagement is actually the way that we all want to make a change and go for that long-term sustainable value creation. And the question is, how effective can you be? And collaboration is something that could really help. I would like to move on to the next thing then. And I think, André, you mentioned we're a passive investor. And it's sometimes difficult to then have, let's say, a stick to hit the companies with when they don't change their behavior. How does that relate to what your participants want? Because I think you've done, together with the Maastricht University, very nice research. Maybe you can elaborate, but I also really want to know what kind of an impact does it have for your pension fund, and how can you rhyme those two let's say, ideas of the purpose of the pension fund with the, let's say, the investment belief that you have?
Once you know what your participants want, it becomes easy, because then you simply do what they want. But finding out what they want is a different ballgame. You don't have a parliament or something like that, so you have to do research. I've seen several researches of several pension funds on what the beliefs and values of their participants were. And then it's, well, quite often asking them if they want a higher return with a good impact on society. And that's not a question, that's a given. Of course you want that. We were relatively late in the game as pension fund for the retail sector. It started with us, with Rana Plaza collapsing in Bangladesh, 2,000 people dead or even more. And that was right in the middle of our supply chain. So our sector was hit by that disaster. And that made us think differently about, we have a responsibility for that supply chain. So we made the supply chain something that we wanted to look into as a pension fund while investing. Then the SDGs came, and we chose 3 SDGs, 3 Sustainable Development Goals: climate change, decent work, and peace and justice. And while we were moving toward that direction, how do we incorporate that in our investment strategy? We asked the University of Maastricht, try to find out what our participants really think of ESG, sustainability, but more important, socially responsible investing. Do they find that important or not? And we did it in a way that it was not a hypothetical question, but it was real. If they said we want it, then we would do it. And we did that by asking them if we should add a 4th SDG, Sustainable Development Goal, responsible consumption. And we asked also if adding that SDG would lower our returns, would you still want it? To start with, a huge a portion of the participants, a majority, wanted us to really look into responsible investing. So it was something like 70% who said, we want that. We don't just want any profit, but we want it to be earned responsibly. And 42% said, even if it costs returns, we still want it. And that was the largest group. So the ones who said, well, then if the returns are worse, we didn't say risk return, that's too difficult. But if returns are worse, then we don't want it. That was something like 25%, and another 30% said, we don't know. So the largest group said, 42% said, even if it costs return, we still want this SDG to be added. And that's a strong leg to stand on, because it was the university. It's now, it's scientific scrutiny. It's being tested all over the world. I've been in Chile, for example, that it was presented, and then scientists look into it and say, well, didn't you make a mistake there? And is this true? And did you ask that question and that question? And are you sure that participants understood what they are saying? So all these loops were there. Yeah. And then it becomes easy. I mean, then I can no longer not do it.
I mean, how do you rhyme that with your, you mentioned in the beginning, it's not in our bylaws to make dreams come true, for example. You have this passive, how do you rhyme it? How do you
to make it clear, the example of tobacco. Perhaps the healthcare sector, I don't know. But if you say, I don't want to make profit of tobacco because it's related to cancer, and I work in the healthcare sector, then it's, you don't want these profits. So that's the relation. If they really believe, if they really want a certain kind of behavior of the pension fund, the only thing I can do is execute it.
Yeah, so you're actually adding the values of your participants to
the values, yes, their beliefs.
Exactly how Dirk mentioned it in the beginning.
That's quite powerful because we always hide behind markets and financial values, and we need to have a high pension. But in the end, the participants are human beings, like all of us listening today and here on Zoom and here in the room. And human beings, of course, they want to have, they need a pension, but they also want to have a nice environment and social justice. So, and it's nice that the survey brings that out. And that also makes it quite clear that as a pension fund investment, it's quite logical to invest as a human being with moral responsibility. And of course, we need to have pension on the table at the end of the day.
It's 1 million human beings, so that's a bit difficult.
Yeah, but still.
But can I ask a question on that, Dirk? Because you say it's values-based. On the other hand, and Mats is very clear. He says it's about reducing risks or increasing returns. You also have this value creation model that you build and that you just explained to us. For me, having a certain purpose of changing things can be different than it can also coincide. We know a lot of examples where we know that if companies don't prepare for the future, they don't have a future. So there it's very obvious. But what about less obvious things like biodiversity loss, natural capital?
Well, or if they are conflicting.
Yeah,
I mean, if you
look at SDG 1, it's in your book a little bit, but not very strong. It's you've got social sustainability and environmental sustainability, I think. If you look at SDG 1, that's beat poverty. If you lift people from poverty, then their carbon dioxide footprint will be larger. So if you have 13 climate change, you want to have a lower carbon dioxide footprint.
I find the solution
there is contradiction between the SDGs. So it's it's not all rainbows.
But also contradiction between some things that cost return and maybe in the short term, and then
but let's take one by one. So the contradiction, I will come back on.
Take them all.
So first of all, why would you do it? I think the big thing which we are not allowed in academia is this investment belief, and what Mats is saying. You're future-proofing your business model because the transition is happening. The energy transition will happen earlier or later, but it will happen. But it's not yet priced in the market. So if you are a passive investor, you just follow the market. So you take the view that this transition is happening, and as an investor, you can help out by speeding it up. And is there a contradiction? Not really, because if at the low end wages are increased a little bit, this carbon emissions and material footprint adds a little bit. Where the real emissions and footprint comes is from the top tier of the income, which have 3 houses and fly a lot. That's where the real carbon and material footprint. So adding a bit to income is quite a lot of academic. The real footprint comes from the West, from the rich people who consume too much.
Thank you, Dirk. I don't want to go into detail into that. Do you want to respond on that topic? Because I don't.
Another thing, you say developments. You say energy transition. IPCC, International Panel on Climate Change, has been very clear for years about nuclear energy. And just in the last report, nuclear energy is out. Germany threw it out. And just in the last report, they said, 1.5 degrees is impossible without nuclear. It's a transition energy source. So from being out, 2 or 3 years later, it was in again. But building a nuclear plant takes 15 years. So these developments are not linear. They are, they change all the time. And looking forward to 10, 15 years, hell of a job. So, and we have to invest in the real world.
This model won't help you to pick always the winners. The only thing, that's if you look at the future, you know that whether you take wind or solar, or you can take both of them, and hydrogen, if you take all 3, then at least you know that some of them that is the future, and you know that fossil fuel will be the past. So which one exactly will win it? That's but at least you know you have to be at that end and not at the fossil fuel end. And nuclear.
First step is to believe that you have an investment belief that it's not priced in.
Yeah,
exactly.
In the value of, and that's
that's not your investment belief. Can I ask Joanne, what is your opinion on that when it comes to PFZW? I mean, combining, let's say, the values with the value-based strategy and the investment beliefs that you have. Can you elaborate a little bit on that and how you make that work for your pension fund?
Yeah, we did the same thing, although I'm not so sure we did it so scientifically responsible as André's fund. But we also did a recent survey in November for a representative group of our participants, asking them about what they wanted in terms of sustainable investing. And there also almost half of the respondents agreed that even if they would have to give up financial return, they still preferred sustainable investing as a strategy. So that's a very important given for us that forms a very good backing for revising our strategy that we're currently in the midst of. So we will announce that in the fall. We also have certain areas that we have excluded from investing. André mentioned that tobacco is one that we've excluded for years now, and controversial weapon industry is another one. We're currently preparing a third one. So there's, it's important to take on board the voice of the participants. At the same time, I'm not so sure when PFZW started with its sustainable investment.
Oh, I'm sorry. Joanna?
Investing strategy, which was more than 10 years ago now. The same answers. I think you lost me.
Yeah,
right?
Yeah, you're back again. So if you want to finish
okay.
your answer.
Okay. I'm just saying, yes, very important to listen to the participants and do what they want. But sometimes you also have to, to tag people along and make them want it, which is actually what has happened here.
That's quite clear indeed. Mats, I think you wanted to react to the discussion we had earlier in terms of passive versus long-term sustainable. What did you want to react on? And
no,
what?
I think that if you want to be a responsible and long-term investor and taking sustainability seriously, you need to be active. That's it. And then you need to, in my view, understand that sustainability is not about charity. It's actually a way to mitigate the risk that is mispriced out in the market. And if you do that properly, you will actually gain returns, better long-term returns. So I think it's dangerous to say to pensioners that if we exclude tobacco, we will actually have a lower return. I think the argument should be that actually it's a mispriced risk again, which I strongly believe. And in the past 3 or 4 years, tobacco has definitely underperformed over time. So again, it's not about charity, it's mispriced risks that you can actually deal with, and then you need to be active.
That is quite clear. I think we have slightly different views here, and that's good. Also, the audience has different views, because Jaap van Dam from PGM is asking, have we left the idea of efficient markets behind, and have you a firm foundation? And on the other hand, we have Jeroen Smit who's saying, thank you for the clear presentation. So courage is lacking to choose for a let's say, a more concentrated portfolio. So we have different views, not only here, but also in the people that are watching the presentation. So I'm not sure if we're going to solve it now, but it's good to address that question to you, Dirk. Have we left the idea of the efficient markets behind? I think you already mentioned. Risk is not priced in. That's your
exactly.
firm belief.
That's what Mats
and Mats is also saying that.
Yes. And In our finance education, also at my school in Rotterdam, we teach students that markets are efficient because if you knew it better, please stop with your education, go to the market and get rich. That's the old joke. But at the end of the day, we did with our students report on big companies, steel companies, oil companies, redo the valuation with ESG factors in mind. They came with completely different, like steel companies, they had 1/3 of the value. And they were comparing it with an investment bank report from JP Morgan. And at the end of the day, many investors are still not really sustainable investing. They're just looking at financial numbers, extrapolating it in the future, and then that's their valuation. So given that the majority of market analysts are not yet looking at these issues, we have this huge mispricing, and I try to educate my students with these ESG factors. It is going to increase, that's happening, but it takes time. So the profession is a little bit behind.
Okay, thank you.
I do believe that markets can be inefficient and that there is something to gain there. But can I gain that as a pension fund? Can I harvest it? And that in a way long term.
So we have 4 minutes left, and that's exactly what I wanted to go to. Suppose we all agree with Dirk and Mats. What would it take for you to implement that? I mean, what, and also for Johan?
Getting people who can harvest this profit. To work for the pension fund.
So really investing in research.
And first making me believe that I can do that.
Okay, that's
lacking the courage. Well, that's a negative way of putting it. But
if you believe it, what do you need to do? Invest in people.
I have a course of 50 students. Next year I will do 100 students, so I will send them to you.
Yes, please do.
And
for
Johan?
Free, then it's good.
And Johan, what do you think? Let's say we believe Dirk and and we need to manage more concentrated portfolios. Dirk and Mats, what does it take for PFZW?
I think we need a little convincing. I think we are already taking steps. And I think finally, it's not just the pension funds that can solve all the problems in the world. I think the mispricing is caused by the fact that CO2 is simply not taxed. Companies are still free to externalize costs to the planet. And once once we stop that, then things will be much, much clearer.
And touching upon that, one thing that was not mentioned here, which is at the core of the problem, I think, is integrated reporting. So not just financial reporting, integrated reporting, where externalizing things like Joanna said is no longer possible.
Integrating
but
the externalities.
long way to go. Companies themselves, within their industry, saying how they are related to different problems.
The good news is that the IFRS, that is the International Financial Reporting Standards, as the body for, they're now working on it. They have a working party and starting on it. So you're fully right. Integrate reporting, getting the information on the table is crucial, because then you know what's happening at your companies.
Okay. Thank you, everyone, for your participation. I think we haven't really solved the debate here, but I see some light at the end of the tunnel, because I would really encourage everyone to think about this integrated reporting, integrated valuation modeling, and then maybe we can actually join, let's say, the sustainable development with making it really tangible for investors as well, and integrating it into everything that we do. So thank you, Johan Kellerman and Mats Andersen on the Zoom link. And also thank you, Dirk and André, for being here. And I hope maybe you can also join the next session of the conference, which will start later today. And I actually have 1 minute left, so maybe you can get a cup of coffee and join the next session later. Thank you all.
Thank you, Masha. Well done.
Thank you, Masha.
And see you.
Goodbye.